Whether you're buying a house, refurbishing your house, buying a car through financing, or even getting a phone contract, your credit score can have an impact on such purchases. So the question is, how do you improve your credit score so that you do not miss out on such purchases? Hi guys, and welcome back to my channel. I hope you guys are doing well. You're having a beautiful day. As a disclaimer, I work in credit risk as a credit risk manager. So in layman's terms, I evaluate the risk associated with lending to various types of customers. So for the benefit of those who do not know, let's start from the basis. What is credit scoring? Credit scoring is a process whereby lenders are trying to predict your future behavior based on your past behavior. And how do they do this? They do this in three ways. The first is information that you provide on application forms anytime you want to borrow credit. The second is any past relationships that they've had with you. And then the third is the information that credit agencies hold on you. So information such as your repayment history, information such as county court judgment. This is basically looking at whether there has been any action raised against you stating that you owe money, and this stays on your credit file for 6 years. We're also looking at information such as CEFAs. So this is asking whether you have been a victim of fraud or whether you have engaged in any fraudulent activity. This again stays on your credit file for 6 years. We're also looking at information such as voter register. Make sure you're on it because councils send that information to credit agencies on a monthly basis. So consistently being at the same address can easily improve your credit score. On the other hand, if you frequently move, that is a red flag because to lenders is asking whether you're facing financial difficulties, whether your landlord is throwing you out, and that is why you keep moving houses. So all these factors influence your credit score. And that is why if you have no history or a poor credit score, lenders can easily reject you or give you the products with the highest interest rate attached, basically the most expensive product because you are high risk, or vice versa. If you have a lot of history and a high credit score, lenders can easily accept you and of course give you the products with the lowest interest rate attached. However, sometimes there are anomalies because lenders behave differently, and also lenders sometimes want to see if you behave in a way that is more profitable for them. And that is why you can be accepted for credit elsewhere, but you can be refused for credit elsewhere. So the question is, how do you find out your credit score? In the UK, there are 3 credit agencies. We have Experian, Equifax, and TransUnion with 999, 1000, and 710 respectively. Although your credit score is an important indicator, another equally important indicator that credit agencies do not have on you that lenders have on you is your salary, because remember, you provide that information anytime you want to borrow credit. And that is why this is the difference here. So that is why based on your salary, you can be refused credit, but based on your credit score, you can be accepted for credit because your salary is used to check your affordability to see whether you can actually afford what you are trying to borrow. So let's take as an example that you earn £2,000 a month. After your deductions, your needs, your wants, and your savings respectively has been taken out, let's just say you are left with £200. And you want to borrow credit, that would mean that your monthly repayment is £300 or £400. Where are you going to get that extra £100 to make that monthly repayment? And that is why based on your salary, it's stating that you might not be able to pay. But based on your credit score, you can be a good customer. So that is why you always have to do a soft search anytime you want to borrow credit, because soft search looks at your likelihood of being accepted, and it also tells you the APR that will be attached to that credit that you're trying to borrow. It does not also affect your credit score, neither does it affect your future borrowings. So now let's talk about tips to boost our credit score. And the first one is to get credit and rebuild. I know you ask me, Chris, how can I get credit and rebuild if lenders are refusing me credit in the first place because I have no history or a low credit score for lenders to predict from? Well, there are specific cards such as Aqua Advance and Marbles that are tailored to such customers. You do not not need a lot on such credit cards. You need £50 to £100. You can run the account, but make sure, the caveat is that you make sure that you repay them off before the due date of every month. So let's take as an example that your due date is the 2nd of every month. Make sure that before the 2nd of that month, you should have repaid them off, because the interest rate attached to that credit card or those credit cards are very high. So you do not want to fall victim. Consistently doing that for 6 months to a year can easily improve your history, give you some history, and of course improve your credit score, after which you can cancel those cards and move on to regular cards. And for those already on regular cards, I would also say frequently spend on your credit cards, but make sure that you make timely repayments, so pay them off before the due date of every month. Lenders will report this information to credit agency, and that will be marked as a timely repayment, which can easily boost your credit score. The second one is credit utilization. Credit utilization basically looks at how much you owe divided by your total credit times 100. So let's take as an example that you have 2 credit cards with a total of 10,000 and a limit of 5,000 on both, but a balance of 3,000 on one and a balance of 2,000 on the other. So in this case, your credit utilization is the 3,000 plus 2,000 divided by 10,000 times 100, which is 50%. That is too high. As a rule of thumb, your credit utilization should not exceed 30%. A low credit utilization shows lenders that you are able to manage your money well and spend within your means. One way to improve your credit utilization is to keep open credit cards even though you do not intend to use them. So let's say you have a balance of 5,000 on one and a balance of 0 on the other. You've not used the other one, and you decide to close that card. Automatically, you've increased your credit utilization to 100%. So although I've mentioned that you should keep open credit accounts or credit cards even though you do not intend to use them, having too many open as well is a red flag, because lenders will worry, or creditors will worry, that in instances that you decide to use all of them, you might struggle to make repayment. A second way to improve your credit utilization is to increase your credit limit. Although I do not advise that, I'm still going to explain because it can help boost your credit score. If you notice that your utilization is around the 50% mark and you're struggling to bring it down, increasing your credit limit can reduce that utilization. However, you also have to bear in mind that having a credit limit of £15,000 or more can reduce your credit score as well. The third point is to make sure that you do not miss any payment. Missing payments is an early sign of financial difficulty. So in instances that you think that you're going to miss payment, just speak to your lenders, because lenders have facilities to help. So whether they will give you a payment holiday, give you a probation period, or can reduce your minimum payment. The fourth one is to avoid multiple applications. If you've been turned down credit in the short term, avoid applying again, because you're only going to get rejected. It's a hard search, so it will go on your credit file and affect your credit score. This equally applies to websites such as comparethemarket.com, because to lenders, it only shows that you are financially thirsty, you are money thirsty, and you urgently need money. 5, end financial relationships with others. If you have joint accounts with someone that has poor credit, that can easily affect your credit score. So we advise that you end such financial relationships. This can be very tricky or difficult, especially if the person is your spouse or a friend, but that is the best way forward. And then of course, you can suggest option 1 to the person for them to use the credit building facilities like Aquafinance and Marbles to rebuild themselves to a desirable level, after which they can join you. Most of the times you hear couples say, we never fight. The only time we fight is when we discuss finances. I remember in my first finance video, the 5 money habits keeping us poor, I touched on a book, All Your Worth, the ultimate lifetime money plan. In that book, chapter 7 talks about love and money, basically how to deal with a spouse that is not financially in shape. So with caution, I would suggest that you both read chapter 7 to see whether it can help you both to get on top of your finances. 6, report and fix any errors on your credit file. This might seem so unimportant, but yet very important. Credit agencies have 28 days to fix any errors that you report or tell you why they do not agree with you. During this time, that error is marked as dispute, so meaning that lenders cannot use this information to make credit decisions on you. The seventh and last one is to be truthful, consistent, and accurate on application forms. Lenders verify the information that you put on application forms, so inconsistencies can lead to an automatic reject. That is already a hard search, will go onto your credit file and negatively affect your credit. So inconsistencies in income, as an example, can easily lead to an automatic reject. Inconsistencies in titles and name can easily trigger a fraudulent activity and of course lead to automatic reject. Lenders need to make sure that they know their customer, KYC. This is a standard that has been put in place to protect institutions against fraudulent activities. So in cases where they're doing due diligence and they cannot verify that this is the true likeness of the person, they would easily reject you. It's a hard search, and then it goes onto your credit file to negatively affect you. If you consider the tips that I have highlighted, you will notice that it is all to do with behavior, your money habits, and not anything magical. And these are the points-based systems based on those behaviors. Also, we need to understand that although your credit score is an important factor when it comes to making credit decisions, an equally important factor is your salary, because that helps us to check your affordability as to whether you can actually afford what you're trying to borrow. Evidence of stability is equally important because it allows us to predict your behavior as an individual. If you're looking to improve your money habits, I would suggest that you watch these two videos. I hope this video has been informative. We're going to build on it in the subsequent future. Don't forget to like, don't forget to share, don't forget to comment, and finally, but not the least, don't forget to subscribe. Until next time, bye guys.